Welcome, my friends. WeWork has warned of a possible bankruptcy. WeWork said in a filing Tuesday that there's doubt about the company's ability to keep operating as a going concern. The company's stock price has been trading below $1 since early this year. Membership has been weaker than expected, which the company attributed in part to a struggling economy. What does it mean for the economy? And, what does it mean for the future of the United States? But, before we get into all of that, please press the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. And, before we continue, a word from the sponsor of this video. Today's sponsor is InnerLife.com, creator of the InnerLife STS system. InnerLife STS is a cloud mobile platform for mental health care and its integration with primary medical care. InnerLife STS is designed for assessment, data collection and analytics, documentation, and progress tracking. InnerLife STS creates and composes conceptualized narratives and builds them into professional-grade reports. These reports are designed for use by mental health professionals, primary care physicians, justice system professionals and universities, and include mental health assessment reports, mental health treatment reports, and treatment progress reports. And InnerLife STS uses doctor-selected pseudonames for all patients. So, only the doctor knows the patient identity. 4 years ago WeWork was preparing for a blockbuster IPO. Now the company is warning of possible bankruptcy. Our losses and negative cash flows from operating activities raise substantial doubt about our ability to continue as a going concern, WeWork said in a filing with the SEC on Tuesday. The spectacular collapse of a company once valued by SoftBank at $40 billion has been years in the making, but is still surprising given the number of large commercial buildings around the world that don the company's name. The combination of the COVID pandemic, which led many businesses to exit their leases in favor of remote work, and the subsequent economic slump, has left WeWork heavy on debt and struggling to generate cash. If we are not successful in improving our liquidity position and the profitability of our operations, we may need to consider all strategic alternatives, including restructuring or refinancing our debt, seeking additional debt or equity capital, reducing or delaying our business activities and strategic initiatives, or selling assets, other strategic transactions and/or other measures, including obtaining relief under the U.S. Bankruptcy Code, the company said. WeWork stock has been trading below $1 since mid-March. It tumbled 26% to 15 cents in extended trading on Tuesday and now has a market cap below $500 million. The company had a net loss in the first half of the year of $700 million after losing $2.3 billion in 2022. As of June 30th, it had $205 million in cash and equivalents and total liquidity of $680 million. It has $2.91 billion in long-term debt. WeWork first sought to go public in 2019. Publishing its initial prospectus in August of that year. With its full financials available for everyone to see, the business was roundly criticized due to excessive spending and risks along with founder Adam Neumann's complex relationship at the company. The IPO never made it out the door. SoftBank founder and CEO Masayoshi Son called his investment in WeWork foolish and his company took majority control of the business in a $5 billion financing package. Neumann was forced to step down. In 2021, WeWork finally became public through a merger with a special purpose acquisition company, or SPAC. But the turbulence continued. WeWork said its revenue grew just 3.6% year over year in the second quarter and declined 4% in the US, where it gets 41% of its sales. Economic conditions led more members to depart, bring down revenue and cash flow, WeWork said. Even SoftBank is spending less on WeWork. In the second quarter, the company contributed $6 million of WeWork's revenue, down from $10 million in the second quarter of 2022, according to the filing. Key factors for whether WeWork can remain a going concern include limiting capital expenditures, increasing revenue and seeking capital through debt or equity issuance. 3 board members resigned last week because of a material disagreement regarding board governance and the company's strategic and tactical direction. Daniel Hurwitz, who had been chair since May, was one of them. WeWork is still searching for a permanent leader. The company said in May that CEO Sandeep Mathrani would step down within days and that board member David Tolley, a former finance chief at Intelsat, would become interim CEO. We Crashed, a miniseries about the rise and fall of the company, debuted on Apple TV Plus last year. If you follow the financial news, you know that there has been a wave of corporate bankruptcies this year. Yellow Corp, the third largest less-than-truckload freight company in the United States, plans to declare bankruptcy on Monday according to a new report. 3 employees of Yellow's sales team spoke to the company's senior vice president of sales, informed them of the plan Wednesday morning. The executive advised them that they were approved to discuss the bankruptcy with customers. That same vice president then backtracked the statement after the news was leaked, informing the sales team that afternoon to correct any news of bankruptcy to customers and that Yellow's talks with the IBT are ongoing. As previously stated, and in keeping with fiduciary responsibility of the company's executives, the company continues to prepare for a range of contingencies. It was reported that a tech employee was also told that the company would file for bankruptcy on Monday and that they should start sending out resumes for other jobs. Instead, the company is using the added time to file for bankruptcy within 1 week, putting the pensions and jobs of thousands of workers on the chopping block. Market analysts from Stephens, a financial services company, estimated that Yellow was losing $4 million a week during the second quarter of this year. The Stephens analysts estimated that Yellow spent $20 to $25 million in cash just in the last week and that it could be losing as much as $10 million a day due to the drop in volume. If these numbers are accurate, then Yellow is most likely well below $35 million in cash and could possibly be out of money entirely. $35 million in cash is the threshold set by Yellow's lenders, led by Apollo Global Management, in an agreement between lenders and the company earlier this summer to relax Yellow's debt conditions in exchange for direct oversight of Yellow's finances by lenders. Once Yellow drops below $35 million in cash holdings, it will be in breach of the debt covenant, and Apollo and other lenders could demand immediate repayment on hundreds of millions of dollars. Lacking the funds to repay its investors, Yellow would be forced to declare bankruptcy and sell off its assets, putting 30,000 jobs, including 22,000 Teamsters, at risk. Wall Street, however, has made it clear it will not inject additional cash without major cuts at Yellow. Over the past few years, Yellow has worked to implement its One Yellow plan, a consolidation of its subsidiaries, including the closure of several hubs and the conversion of many jobs into utility positions, in which workers both drive trucks and work the docks. The intention is to cut expenses by shuttering physical locations and slashing labor costs. Yellow's investors have demanded that Yellow demonstrate its ability to eliminate jobs and cut pay and benefits before it is given another infusion of cash. While Phase 1 of One Yellow has already been implemented and thousands of jobs already lost, the Teamsters have offered no opposition to this consolidation except on the grounds that Yellow must codify the changes in contract language, in other words, that it carry out these cuts with the involvement of the union bureaucracy. On a specific industry basis, the financial sector is under duress following the collapse of Silicon Valley Bank, with multiple other institutions following suit in recent weeks. Retailers from Bed Bath & Beyond to David's Bridal have filed for bankruptcy in recent weeks. Envision Healthcare, a medical staffing company backed by KKR, was one of the 6 firms to declare alongside Vice. What this assorted list shows is that no industry is safe from balance sheet bogeys. If a company got too aggressive loading up on debt during the low interest rate era, chances are it will soon be feeling the pain. And, the recent bankruptcy of Vice Media is still fresh in everyone's mind. Once a digital media darling, Vice Media Group on Monday filed for bankruptcy protection after years of financial troubles. A consortium of Vice's lenders, which includes Fortress Investment, Soros Fund Management and Monroe Capital, is looking to acquire the company following the filing. If you follow this channel, you already know that the entire media space is experiencing huge numbers of layoffs right now. Earlier this year, Disney said it would slash 7,000 jobs from its workforce as part of a larger reorganization of the company that will see it cut costs by $5.5 billion. The announcement was made during Bob Iger's first earnings call since returning as CEO. But, what do you think? Please leave us a comment below and hit the like button. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.